4.1 trillion US dollars. That's how much the coronavirus pandemic could cost the global economy. According to the Asian Development Bank, the figure is only a conservative estimate. And that's because possible social and financial crises, as well as long-term effects on healthcare and education, have not been taken into account. A shorter containment period could pare the losses to 2 trillion US dollars. Governments and central banks across the globe have stepped in to ease the pain, pledging more than 5 trillion US dollars in stimulus and easing monetary policy.
I think on the monetary policy front, I've been very pleasantly surprised by not just how quickly central banks have moved globally, especially the Fed and the ECB, but also the magnitude of the moves that they've done. So things that were basically took the whole GFC to do were done in kind of the space of a week.
I think we've now moved to a very urgent policy footing, and you can see that the commitment from policymakers, both monetary policy, fiscal policy, and of course, perhaps most importantly, public health response, has moved in the West from a less urgent footing as recently as 3 or 4 or 5 weeks ago to a total, it seems to me, whatever it takes mentality.
In response to the crisis, the Singapore government has rolled out 3 support packages totaling 60 billion Singapore dollars, or 12% of GDP. Meantime, the city-state central bank has eased its policy stance.
I think Singapore has done a tremendous job of this coordinated policy response because it isn't possible to deal with a virus-related economic slowdown solely by using monetary policy or solely fiscal or solely public health. We must use these together. And I think Singapore is doing a very good job of balancing the need for, of course, containment and confront the virus.
The Monetary Authority of Singapore uses the exchange rate as its main policy tool rather than a benchmark interest rate. It lowered the midpoint of the currency band and also reduced the slope of the policy band to 0% appreciation. This shows that the central bank doesn't want the Singapore dollar to strengthen against other currencies.
I think in this environment, a minimalist approach was actually the correct approach. We are unsure about how long this current crisis will last. We're unsure about if the demand side or the supply side will be impacted the most. So taking this minimalist approach is probably the prudent action. And in fact, a stable currency is probably the best policy in this environment.
Central banks across the globe have swooped in to support their economies. Many have either slashed interest rates or embarked on fresh bond buying programs.
We came into this from a period of strength, and the Fed reacted very quickly because they understood, not just the Fed, the ECB, BOJ, PBOC, all acted pretty quickly in order to ensure that there were enough measures in place to stop a liquidity crunch from turning into an insolvency crunch. What global central banks have done is they have reacted to a financial crisis. They were able to rapidly see what was coming, a seizing up of the wheels of finance. They needed to grease those wheels to make sure we didn't see a collapse.
The ECB, for example, has committed to buying around 1 trillion euros of corporate and government bonds. In the United States, the Fed has embarked on a flurry of actions, including lowering its main interest rate closer to 0 and restarting large-scale asset purchases. This is alongside the $2 trillion stimulus package passed by Congress.
If they say they're going to buy only X amount of bonds, you can be sure that they'll buy however many they need to buy. The thing that you can definitely expect them to do next, I believe, is going to be yield curve control. Don't forget that they have not done the BOJ's equity ETF purchases. That's also something that the ECB has not done, and also the Fed has not done. negative rates. I'm not sure we will see that potentially kind of in the U.S. in regards to like as a policy kind of perspective. But as we've seen, the Fed's ability to work with the Treasury, which is very, very key here, and a lot of these measures we've already mentioned would not be possible without the Treasury.
Despite bold policy measures, markets are still seeing volatility due to uncertainty over the COVID-19 situation. US stocks plunged in the first quarter, with the Dow and S&P 500 falling 20%. So are markets close to a bottom yet?
Well, from my perspective, I think things are going to get cheaper. You obviously never know the lows, and I should also point out that the market will bottom way before we've seen, COVID start to fall globally in regards to confirmed cases, and way before we see the worst economic GDP print, right? I will say, if you go back to the .com, we pulled back about 50% on the S&P. If you go back to the GFC, it's about 56%. We're still only kind of down about 20%, 25%, depending on kind of how the day is kind of going. It's not to say that they aren't pockets of opportunity for investors, especially in bonds and credit, especially in Asia credit.
What's important is to think about the signposts for where we might be getting to a more normal, less volatile market situation. There are 3 signposts. First signpost is a peak in new infection rates, so the virus itself. Secondly, bold policy action. This one I think we can say we are seeing. Last signpost, third signpost, is a sense that some of the urgent selling generated by the market volatility is now finishing. Again, this one I think is very advanced.